Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Enterprise Value, EV, and its impact on investment decisions. Formula for calculating EV. The formula for enterprise value is straightforward. EV equals market capitalization plus total debt plus minority interest cash and cash equivalents. Each part of this formula carries its own meaning and importance. Market capitalization. This is the value of a company's equity. You find it by multiplying the current stock price by the number of outstanding shares. This gives you the baseline market perception of the company's worth. Total debt. Total debt includes both short-term and long-term liabilities. It's what the company owes to lenders and bondholders. Debt increases EV because any buyer of the company would assume those financial obligations. Minority interest. Minority interest refers to the portion of subsidiaries owned by outside parties. Since EV reflects the entire business, not just the parent company, minority interest is included in the calculation. Cash and cash equivalents. These are subtracted because cash lowers the net cost of acquiring a company. If you're buying a business, any available cash offsets the amount you'd need to finance. In short, the formula builds a complete picture of a company's total value. Each piece fits together to account for either obligations, like debt, or resources, like cash. Example calculation of EV. Let's put this into practice. Imagine you're evaluating a company, TechPro Inc., to calculate its enterprise value. Here's the data you have. Stock price, $50 per share. Shares outstanding, 10 million shares. Total debt, $200 million. Minority interest, $20 million. Cash and equivalents, $50 million. Using the formula, let's break it down step by step. Calculate market capitalization. Multiply the stock price by the shares outstanding. $50 times 10 million equals $500 million. Add total debt. Add the company's debt to the market cap. $500 million plus $200 million equals $700 million. Add minority interest. Include the minority interest. $700 million plus $20 million equals $720 million. Subtract cash and equivalents. Reduce the value by the company's cash holdings. $720 million, $50 million equals $670 million. Final EV, $670 million. What does this mean? If someone wanted to buy TechPro Inc., they would need $670 million to cover the stockholder equity, debt obligations, and minority interests, minus any cash already on hand. By following this step-by-step process, you can calculate EV for any company. It's a methodical approach to understanding the full financial picture, offering insights beyond just market cap. Limitations of enterprise value. Enterprise value, EV, is a widely used metric, offering insights beyond market cap. However, like any financial tool, it has its limits. Understanding these limitations can help you avoid potential pitfalls when analyzing a company's worth. Situations where EV may mislead. There are times when EV doesn't tell the full story, leading to inaccurate assessments. Here are some common scenarios where EV might give a skewed perspective. Companies with high cash reserves. EV subtracts cash and cash equivalents, which can significantly reduce the EV for cash-rich businesses. While this is standard, it may downplay the value of companies that use their cash reserves strategically for growth or acquisitions. Inconsistent debt structures. EV includes total debt in its calculation, yet not all debt carries the same weight. Highly leveraged companies with long-term, low-interest debt might appear riskier than they really are, even if the debt's terms are favorable. Fluctuating minority interests. Minority interest can vary widely between industries. For companies with large subsidiaries or partnerships, including minority interest may overstate the company's true enterprise value. Limited use in certain sectors. In industries with unique financial setups, like banking or insurance, EV may not be the best metric. These sectors rely on specialized valuation methods due to unique balance sheet structures. In short, while EV offers a broad picture, it's not always nuanced enough to account for sector-specific or financial nuances. Comparative analysis with other metrics. How does enterprise value measure up against other popular valuation metrics? Let's break it down and see where EV shines and where it doesn't. EV versus EBITDA. EV is often paired with EBITDA to create the EV/EBITDA ratio, a key valuation tool. While EV provides a comprehensive view of value, EBITDA focuses on a company's earnings potential before expenses like interest, taxes, and depreciation. Here's the key difference. EV accounts for financial obligations and available cash. EBITDA shows how well a company generates profitability from its core operations. EV versus P/E ratio. The price to earnings P/E ratio is another popular valuation metric. It compares a company's stock price to its earnings per share, EPS. Unlike EV, it focuses solely on equity, leaving out debt and cash. EV reflects the total value, factoring in the entire capital structure. P/E highlights investor sentiment and profitability relative to share price. EV's role in industry comparisons. When companies have vastly different capital structures, like tech companies with minimal debt versus utilities with large liabilities, EV adjusts for these differences. Other metrics don't always provide this level of comparability. Each metric serves a purpose, and EV's strength lies in its ability to account for a company's complete financial position. But relying on EV alone? Not always ideal. Combining it with other metrics like EBITDA and P/E can create a more balanced view. Conclusion. Understanding enterprise value, EV, is essential for anyone navigating the world of finance and investments. EV goes beyond surface numbers like market capitalization by factoring in debt, cash, and minority interests to provide a more comprehensive view of a company's worth. It's a tool that works across industries and is especially helpful when comparing businesses with different financial structures. Why EV stands out. EV offers insights that other valuation metrics can't, particularly when used alongside tools like EBITDA or the P/E ratio. It accounts for debt and subtracts cash, showing the true cost to acquire a company. EV enables fair comparisons, even for companies in different industries or with varied capital setups. It's highly valuable in evaluating merger opportunities, identifying undervalued companies, and conducting investment analysis. It's like looking beyond the price tag of a car to check its total ownership costs, including loans, repairs, or cash rebates. In finance, those extra details make all the difference. Key takeaways. EV accounts for debt and cash. Unlike market cap, EV gives a full view of financial obligations. Use EV for comparisons. It standardizes valuations across industries or capital structures. Pair EV with other metrics. Combine it with tools like EV, EBITDA or P/E for well-rounded insights. While EV has its limits, it remains one of the most trusted tools in finance. Whether you're a seasoned investor or just starting, it's worth adding to your financial toolkit. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.